Thank you so much for everyone who has joined us early. We'll be starting the webinar at 12, but please feel free to fill out our quick poll on where you're joining us from in the meantime.
You know, I could see the clock. Now I can't.
Good morning, everyone. Thank you so much for joining our webinar. We'll be starting in 3 minutes. In the meantime, please feel free to fill out our poll, or if you have any questions, you can always send them to us in the chat box. everyone. Thank you so much for joining our Beyond Grants webinar. My name is Melanie and I'm the Communications and Network Engagement Manager here at the Ontario Nonprofit Network. If you're new to ONN, welcome. We're a network of 58,000 nonprofits and we work in public policy, advocacy, and helping provide services to strengthen our sector. If you're already a member, we hope that you enjoyed this webinar and that you're able to use some of our other great member services, such as our $100 discount to Nonprofit Driven. If you experience any technical difficulties during this webinar, please try to reopen your browser, and if that doesn't work, you can call us at 416-642-5786. Now we're still waiting on a few more participants to join the webinar, so while we wait for these participants, we're going to do a quick little poll to see what you're most interested in gaining. So of the options in the poll, we have some of the things that are most important to gain from this webinar. First, what is debt financing, a loan, and a line of credit? What do conventional lenders look for in a borrower? How do you know if you're ready for debt financing? What are some ways to identify your borrowing profile? And how and when to get ready to apply for a line of credit? So we'll give another 30 seconds to fill out the poll and then we'll begin. Wonderful. It's great to see such a variety of what people are interested in. The top one that people are interested in was ways to identify your borrowing profile. So we're going to try to cover all of these topics today. And you may be wondering, why is ONN offering this webinar? Well, maybe your organization is looking to diversify its financing options, or the new funding realities may make it more challenging to continue to serve your mission and communities. This webinar will help address both of these challenges. One of ONN's policy priorities is to strengthen community wealth across Ontario through the nonprofit sector. In our advocacy work, we emphasize the role of the nonprofit sector as an employer and economic actor, creating jobs while meeting missions. When nonprofits work together to keep investments circulating locally, it strengthens the work we do to support thriving communities. We are also advocating for a stable funding environment and an ecosystem of funding and finance so that nonprofits have access to appropriate funding. You can find more information about this on our website, and we'll be sharing some more information later on in the webinar. Our goal for today's webinar is to provide all this information to you in 60 minutes. Before I go further, I would like to do a land acknowledgement. ONN recognizes that we are on the traditional territory of the Mississaugas of the New Credit. This land has been stewarded by many Indigenous peoples for time immemorial, including the Wendat, the Haudenosaunee, and that Toronto is also a part of the Métis homeland. Toronto is home to many Indigenous peoples from across Turtle Island. And now our agenda for today. First, we're going to talk about what is debt financing, how nonprofits and charities can leverage these tools. What is a loan or a line of credit? How do conventional lenders look for in a borrower? Are you ready? What are ways to identify your borrowing profile? How and when to get ready to apply for a line of credit? And lastly, we'll be doing an interactive discussion with our panelists where you can ask questions. Our speakers today are extremely qualified in this field, and I'm so happy to introduce them. First, we have Beth Coates, a financial manager, CPA, and CA. Beth has 25 years experience as the financial manager of the Canadian Alternative Investment Foundation and Cooperative. They have been providing investment funds and financing to the cooperative, nonprofit, and charitable sectors across Canada for over 30 years. Beth is a chartered professional accountant who has extensive experience in both the nonprofit and corporate sectors as a financial analyst, corporate risk manager, and controller. She has contributed to socialfinance.ca and written policy papers for the Ontario Nonprofit Network and the Canadian CED Network. Secondly, we have Rebecca Waterhouse, who is an Impact Investment Associate and MPNL. Becca has 6 years experience analyzing data on social entrepreneurship and community development strategies. Her experience includes being a frontline worker and consultant for nonprofits. Rebecca holds a Master's of Philanthropy and Nonprofit Leadership from Carleton University in Ottawa, Ontario. She is currently pursuing her Sustainable Investment Professional certification. During the webinar, please feel free to share questions for both Rebecca and Beth in the chat box. We'll try to answer as many questions as we can at the end of the webinar. If you have any comments you'd like to share with the group, you can also write in the chat box, or even better, join the conversation online through social media by tagging the Ontario Nonprofit Network. Now, I'd like to pass it on to Rebecca.
Thanks so much, Melanie. So a little bit about CAIF and who we are. So CAIF is a registered charity. We're established with the sole mission to offer low-cost, flexible financing to other charities to help them operate more effectively and to meet their missions better. We were established in 2012 with $4 million in assets, and effectively we're building off 35 years of experience of the Canadian Alternative Investment Cooperative, who is a social lending pioneer in our sector. And we believe no one else has more direct investment experience in the sector than CAIF does.
Hello, everyone. My name is Beth Coates, and I'm the financial manager, as Melanie said. And we'll get right into some of the technical parts of what we want to talk about today. So, what is debt financing? It pretty much has three most commonly used sort of three components, and that is mortgages, term loans, and lines of credit. So we'll go through each one. So what is a mortgage? Well, a mortgage by and large is a loan that is used to buy real estate and then is secured by that real estate. And if you're looking to do a mortgage, your lender usually is going to look at some parameters, and this is the whole getting ready to borrow piece, about whether or not this is an investment that works for them. And the first one is about appraised value. So most conventional lenders will lend up to 60% of the appraised value. So in other words, if you go and get an appraisal and it says that it's $1 million building, they're probably interested in maybe about $600,000 loan. That's probably the most that you'll be able to borrow. But that's not the only thing that they're looking at. They also want to get great comfort that once a mortgage is set up, that you will be able to make those monthly payments. That's when another really important metric comes into place, and that is the debt service ratio. Anyway, don't worry, this isn't going to be a lot of numbers today, but I do think it's sort of one technical piece that that is really important when you're talking about mortgages. And that is this debt service ratio, which is basically gives the lender comfort that you're going to be able to make the monthly mortgage payments. So how do they calculate this? Well, they take a look at your revenues and they take a look at your other operating expenses. And then they see, well, what's left to in fact cover the mortgage. And that, a little bit of a fancy name, is the excess of revenue over expenses before interest and before amortization. So whatever that figure is divided by the number of mortgage payments that you have to make during the year, and that gives you this ratio. Now, most institutions would look for a minimum of 1.1. So in other words, if we look at my slide, if you had $100,000 worth of mortgage payments to make a year, they would want to see that your excess of REO BIA was at least 110,000. In my example, it's 125,000, which gives you a 1.25 ratio. So what does that mean if you're in your organization? Let's say you have $1 million of revenue a year and all your other expenses are 875. That means you would have this 125 that would be available to service your mortgage, hence giving you the 1.25. So really these two are kind of the fundamentals of what a lender is looking for when they're going to do real estate lending. What's the value of the property? What is your capacity to service the debt that you're taking on? So we'll go back and take a look at some of the other points about mortgages. Now, you may have heard of second and third mortgages. What I was talking about in the second point was a first mortgage. And that means that's the only debt that's secured by a piece of property. But sometimes, especially nonprofits, don't have all the rest of the money. They don't have the 40%. They don't have the $400,000 that I talked about in my example. So for them, they may go and get a second or a third mortgage to kind of fill the gap. You may have saved $200,000. The bank is willing to give you $600,000. You're going to have to find some way of putting those together. That's where a second mortgage comes in. They're usually a little more expensive because, as you can see, they're a little riskier than the first mortgage, but they can really make a difference. Our predecessor, CAIF, did quite a lot of second mortgages. And what we would do is we often did them at interest rates that were very close to the first mortgage. That was a real benefit of us being a charity and us doing this. And it allowed for the whole kind of financial picture of buying a property to come together. The other things you're going to want to have to think about are the term. Usually mortgages are a 5-year term. That's standard, which means that you then, while you're locked into your interest rate, and you're locked into this agreement for usually about 5 years' time. The term is not the amortization. The amortization is how quickly you're paying off your mortgage. So, you think of just when folks buy a house, and sometimes they'll have a 25 or 30, and I think they're even going higher these days, amortization. So that's the length of time that you will be making payments to get the mortgage paid off. And the last thing I want to briefly talk about with mortgages is community bonds. A lot of talk about community bonds these days, and really what a community bond is, it's a mortgage that's held by all the bondholders. So often sort of an organization, especially if they can get first mortgage financing, but they can't get that second, they'll go out to the community. They will get a second mortgage and then basically sell that second mortgage in pieces to their supporters in the community as a community bond. The next thing that I wanted to talk about was term loans. And a term loan is basically a kind of standard loan that you would get, the standard sort of operating loan that you would get from the bank. They're usually smaller value. I mean, before I was talking about buying real estate, which is usually big lending, and they're usually sort of for a smaller amount. They can be secured or unsecured. Normally, if you're dealing with a financial institution, they will want some kind of security. So you're going to have to pledge whatever assets that you have for the loan, or be part of a guarantee program, something like that. Usually the term and the amortization are the same. So you would get a 5-year loan, which would be paid off in 5 years as well, unlike a mortgage, which would carry on over several terms. The rate that's set, and we're always asked, what rate do you charge, is usually a function of risk. I'm going to talk about risk a little bit more in a further slide. But if the sort of the best security and the best loans, those get usually the best rate. Sort of, you hear sometimes about the bank prime rate. some prime or prime plus 1 or 2. Basically, the bank has to make an assessment about how risky you are, and that's going to drive ultimately the interest rate that they charge you. If you're a nonprofit or a charity looking for a loan, it'll usually be for a specific purpose. Maybe you've moved to a bigger office space and you need to do leasehold improvements. Maybe there's a certain kind of machinery that you have to buy. Maybe you have to buy more equipment. Those are the kinds of things that normally would be financed with a loan. If you get a loan, usually your lender will want to see you over the life of the loan, the 5 years, 3 years, make sort of certain standards. There'll be conditions. They'll want to make sure that you're operating positively and whatever other metrics they're comfortable with, that you're still a good bet. And then sometimes you will have heard of something called a demand loan. And what that is you've got everything set up, you've been lent the money, but the bank, if they do become uncomfortable with the situation, basically can call the loan at any time. The third thing that we wanted to talk about today was lines of credit. So kind of the dictionary definition of it is a preset amount of money that a bank or credit union has agreed to lend you. Now, they're used all the time in the for-profit world because there are cash crunches. No one has an operating cycle that looks the same exactly every day. There's times that cash is flowing out because they're buying things. There's time that cash is flowing in because they're selling things. And to smooth this out, this is why lines of credit are used. And we firmly believe that in their own way, not-for-profits and charities have exactly the same situation. There's times during the year that you're spending lots of money and times during the year that money is coming in. Once that preset amount has been established, then you can draw on the line of credit to meet your needs up to the maximum. You can also repay it at any time. So of course, the benefit of this is that you're only paying interest on what in fact is outstanding at any given time. Most lines of credit, though, will have some kind of minimum payment. Usually it'll at least be the interest on the outstanding amount. And depending on how the line's set up, they may ask you to pay 10 or 15, 20% maybe of the outstanding line at any given time, just to give them comfort as the lender that you're properly managing their line of credit. So I said I'd talk about risk and how lenders look at you. And there's something colloquially called the 5 C's of credit. And this slide gives you some detail about what they are. Now, the first and the foremost is the collateral, which is basically the assets that you can pledge against the debt. In the mortgage, that's a pretty straightforward situation. It's the real estate. But also, organizations pledge other assets that would have value to a lender. That's your collateral. Your capital, again, to go back to the mortgage example, is sort of how much money you have. So in my real estate purchasing example, where the organization only had 20% of the purchase price, that's kind of your capital. So obviously, the more you can bring to a situation, the better it is, and the more comfortable that the lender is going to be. The next one is capacity, and that's when they start looking at your historical financial statements, your projections going forward to see, okay, based on how they've performed and where they think they're going and what they think their access to funds is, are they going to be able to service the debt? Back to the debt service ratio, it would be based on your capacity. The next one is conditions. And conditions is very broad. It includes things like our sort of general economic conditions. Are we going into a recession? Are you located in a place that, that there's low unemployment, that kind of thing. It's also the conditions that are specific to your organization. For instance, is there a change in government that is either more or less predisposed to support the kind of work that you're doing? And lastly is character. In a lot of ways, it's the most important one. It's you. It's your board. It's you, your experience, your demonstration that you have the capacity that you are capable of running your organization and give the lender comfort that you're someone who's going to pay them back, basically at the end of the day. On our website, we go into these in much more detail, and so there's a bit of a checklist, if you will, and you can take a look at yourself vis-a-vis the various metrics. Okay, so then there's really, now we're getting down to the hardcore, and that, or the inner core, if you will, and about what a lender is going to think about when you approach them about borrowing money. So the first one is, do you understand your business model? Do you see, I know you're a nonprofit and I know you're a charity, but there's kind of a business piece. As long as money's coming in and money's going out, there's kind of a business piece to it. Do you know how much it costs you to deliver what it is you're doing? What do your overheads look like? If you're getting X amount of revenue, what percentage of that revenue is required for staff salaries, supplies, et cetera, et cetera? So do you understand your business model? The next question is, why do you want to borrow? Do you want to strengthen your organization? Do you want to get up to the next level? Is there some specific project that you want to do that makes sense for your overall organization? So really, why, other than we're running out of money, has to be addressed. And that leads to the next question. Will it strengthen the organization? Are you borrowing to grow so that overall you hope to be in a better, more secure place than you were maybe today, or than you were five years ago? And then how are you specifically going to employ this loan to do that? Maybe you're going to buy something. Maybe you're going to buy real estate. Maybe you're going to move up into bigger space than you have now. Maybe you're going to upgrade a bunch of your equipment so that you can more effectively deliver your program. And lastly, and I guess maybe this is the most important, and in the questions that were sent to us before the meeting, we definitely saw this. You need support from all of your stakeholders. As a nonprofit or a charity, you are in a very interesting stakeholder position. You've got those you serve, you've got your staff, you've got your board, you've got the general public. So your stakeholder situation is probably the trickiest of all, but taking on debt really has to be discussed, batted about, and really you have to have full buy-on for it to be successful. Okay, back to you, Becca.
Back to us, yes. So we recognize that you all are here because you want to do things differently, and so does CAIF, and that is why CAIF designed Community Lifelines of Credit, which is a line of credit program designed specifically for the needs of small Canadian charities. So how we know that this need exists? So from our experience in the sector, we recognize a persisting problem of tight cash flows. And compounding this issue of tight cash flows is the fact that many nonprofits and charities do not have the assets to pledge as security. And what that means is that there's a lack of access to conventional loans at affordable and or accessible rates. And so this is a self-perpetuating cycle in the short term, as a short-term issue that kind of consumes a nonprofit's or a charity's operating cycle, and is very distracting in your core mission, to your core mission. So, but during these times of stress, it's even more heightened and pertinent to start addressing these issues, to start really thinking about your viability and your sustainability for the future. So, we know at CAIF that nonprofits and charities are resilient, well-managed, and good investments. And I'll let Beth speak to the specific characteristics that make nonprofits and charities good investments.
Thanks, Becca. So back about 2 or 3 slides ago, I talked about the 5 C's of credit. And for conventional lenders, pretty much they like to see you score on all 5. But we know from our experience, there's very limited collateral and there is very limited capital in the sector. That's why the founders of CAIF, the cooperative that preceded CAIF, got together and organized the cooperative 35 years ago. So what do we do then to continue to lend, usually in the absence of strong collateral and in the absence of lots of capital? What we do then is we really focus on the other 3. This is why I said in a lot of ways character is one of the most important things. Getting to know you, working with you, getting comfort about you. That's how we have been successful in the last 35 years and have had a very, very low default rate, is that we've really worked with our borrowers to get to where we're going. We spend a lot of time getting to know you, understanding your capacity, and understanding the environment that you're in. Of course, after 35 years as well, we know this sector, we know the conditions, we know what it is that you're dealing with, sort of confronted with, and how you're coping with that. A couple more C's, I guess. Okay, back to you, Becca.
Yeah, so a little bit about the opportunity. Simply, we want you and your organization to get the credit that you deserve. So we're offering up to $50,000 lines of credit, and we're not doing the banking ourselves. We're going to be partnering with Van City Community Investment Bank, and the perk about that is that you can stay with your bank and you can receive and pull from the line and pay back the line through your current banking institution. So what happens is CAIF guarantees the line. And so what this means for Van City is that they can offer you their best customer rate at the 1.15%. And so all in all, CAIF is offering you money, yes, but we're also offering you a commitment. We're offering commitment to financial mentorship from application phase to the extension of the line and through the financial management of the line. We're going to be supportive and we're going to be very understanding of the situation that you're coming from in your operational context and work with you to tailor that line to your needs. And all in all, it's going to lead to your improved financial literacy and capacity to do more with debt and allow your mission to succeed. So it's a very comprehensive package, and we believe that it's successful based on our 35 years of experience in the field. So a little bit about the benefits of a line of credit, or sorry, we're going to go to a little bit about how you would use it. So common scenarios in nonprofits and charities where a cash flow is tight are seen here below. And so listen to these and see if any of these resonate with you and your organization. So payroll is withdrawn on the last Thursday of the month. However, your municipal transfer does not come in until the first of the following month. So we see that gap. Example number 2, you have received funding for a project. Funding is 50% upfront and 50% on the back end. And you've completed the project, submitted your reporting, and received approval for final payment and are now running low on cash. But you know that 50% is coming in, so you have that expectation. Scenario number 3, you have been given notice that you are eligible for a new stream of financing. However, you will need to hire new staff, cover all of those upfront costs, demonstrate that the program is up and running, and then the funding will begin. And scenario 4, a disproportionate amount of your funding arrives in October due to your annual gala, or perhaps for you it's in February. In the months prior, though, you have to incur the upfront preparation costs and needs to run the day-to-day operations, and you're seeing shrinking cash in your bank. So in all of these scenarios, a line of credit would strengthen your organization and not hinder it. And this is because you have a determined need, a cash flow need. And it's not related to replacing a major funder or a reduction in earned revenues. And also you have a plan. So you have a specific purpose and plan in place, and you also have a repayment plan. So you do have expected revenues to come in, and you can afford to pay this back. And then finally, most importantly, you have support and capacity to manage it, because you have this you forecasted the ability to know your expected revenues, and you see and you can plan for these shortages. So we can now speak to a little bit about the benefits of line of credit.
Okay, just a point of clarification about the 1 1/4. That was 1 1/4% over what at any given time is the best customer rate at Van City. So I don't know, I think that's about 3.5% plus 1 1/4%. So just for a point of clarity, and it will obviously move as interest rates, go up and down. Although, as we all know, they've basically been down for the last few years. But you can see what a benefit that is for basically an unsecured line from a financial institution would never be available at that percentage. And us as a charitable foundation, that's what we're doing to provide other charities with low cost debt. I just wanted to make one other clarification just in our relationship again with Van City Community Investment Bank. They are actually the banker. They would be moving money in and out of your account on your say-so. And they will do all of that because we have agreed to guarantee the loan. So should there be difficulty with the loan, it is on us. I'm going to talk about this a little more later. So that's why we have to get so comfortable with you, because we are investing in you. We are using Van City to actually sort of do the mechanics of it. So as I mentioned, there we go. As I mentioned, the interest rate is low because we are providing a guarantee to Van City. They are looking to us as the guarantor on the product. And the advantage to you, of course, is it means that you would have access to money whenever you have a short-term cash flow. Sometimes even knowing that the money there is worth quite a lot to organizations, even if they seldom use it. It just means it's something they don't have to worry about. They don't have to worry about a 3 or 4 day gap between when the payroll is made and the next tranche of funding comes in, either from the city or the province or wherever they get their funding. You can access obviously as much of it only when you need it and return it when you don't need it, and you're only paying interest on the amount that's outstanding at any given time. So let's talk about the process. So this slide talks about how we actually do it and how you would approach us if you were considering. And by the way, line of credit, a loan, or a mortgage. We still do the others as well. So basically, we have an online application for all 3 types of lending. We ask that you call us to start. We like to talk to you to start. If we don't think there's any kind of fit, we're not going to waste your time. I think you'd probably appreciate that's a good idea. And then there's sort of a code there's a code to get in, and then you can start filling in the application. Once the application is completed, it would be reviewed by the staff. That would be Becca and me. And if we think, again, this is a good fit, we would bring it to our credit committee, which is made up of experts and business people within the community. It's basically their job then to recommend or not the application to our board, who approves it and basically gives Van City at that point the okay, the get-go to actually set you up and make it possible for you to be transferring money in and out. And then the 5th piece, of course, is that you would use it as required. You would pay the interest on the outstanding loan and repay it as per the loan agreement. So what we would do is, based on your circumstances, we would tailor make a loan agreement with you about how much we think you should be paying back at any given time. The last thing we want to have happen is have you sort of run up to the maximum and then be in some difficulty. So there'd be some monitoring and hopefully working with you, and hopefully what that does is make you the most successful possible using this. We don't want to just sort of drop it in your lap and run away. And that's really what the bar on the bottom of the slide is about. We understand after 35 years of doing this, it's not easy. It's not what you do every day. And you need support, and that's what we're here for. We're here, as I said, we like to talk to you before we even start. We want to help you through the application process. We want to help you get ready when the credit committee decides to do this, and we want to help you even when the loan is out, both with financial literacy and just helping you manage and using this as a tool to strengthen your organization.
That's great, and I think just to clarify a little bit, we can move on to our resources that are available. While CAIF extends to registered Canadian charities, that does not mean that any of these principles are not related to nonprofits in general. Investment readiness and how we described it today in getting there, and those three characters that social lenders look for are very pertinent to nonprofits. So keeping those in mind, there are a bunch of social lenders in the neighborhood. So Van City Community Investment Bank is doing business banking, but they are not doing individual banking at the moment, personal banking. We also have Alternative Savings, very much a social lending pioneer as well, an established credit union. And so we have had previous agencies who we've worked with in discussing investment readiness and the application of a line of credit to their operational context, and they've been successful in working with Alternative Savings and approaching them for a line. So that is a win. And the Community Forward Fund also very established, and they do a diversity of investments ranging from loans to mortgages as well. The Canadian Cooperative Investment Fund focused on cooperatives, and Tapestry Community Capital, as we spoke to community bonds within the mortgage section there, they are doing a lot of very interesting work with community bonds right now. And we also have Duca Impact Lab. So there's a new opportunity arising there for working capital opportunities, lines of credit for social entrepreneurs. And they're doing some new info sessions on that. The Toronto Enterprise Fund has mixed capital and catalytic grants opportunities for many social enterprises and nonprofits. Fair Finance Fund is offering a new financing opportunity for local food movements and co-ops. And then there's Verge, who is also doing a diversity of loans and mortgages as well. So we are very hopeful that in receiving all this information and digesting it and looking at your case, and if you do determine that a CAIF line of credit is well suited, or you believe that you're interested in taking next steps, we would love for you to speak to us and reach out to us. So we're very accessible by email, by phone. We love to have a phone call with you and discuss your needs and discuss if a CAIF line of credit is right for you at this time.
Wonderful. Thank you so much. Thank you, Rebecca, and thank you, Beth, for going through all this information and really highlighting that CAIF is a lot more than a financial services provider. You really do provide support and mentorship as well throughout the process. So we do have a few questions. If anyone else has any additional questions, please feel free to write them in the chat box. Before this webinar, we had brought up one main question, and this question was, what are the largest barriers to being able to access debt financing? And we found that there were a few trends. So I'm just going to list them out right now. So one of the trends that people commonly found as a barrier was funding can be canceled or changed year to year, and so they're nervous about being able to make those payments. The second one was the public perception that they would receive by using public debt as a nonprofit. The third one was the fear of not being able to pay it back. And the fourth trend within all the comments was the security required for our loan. And a lot of questions throughout this webinar also have related to this and about, are board directors liable and what does that mean? So I'd love to pass it over to Beth and Rebecca to answer these and see if you have any insights on these barriers.
I'll kick off. Yeah, we got these questions beforehand, and I want to thank everybody who did send questions beforehand. They were very thoughtful. They sort of, as Melanie said, they fell into some general categories, and these are helpful for us as well. It is wonderful to know, you sort of sit there and think about what you think you're hearing, but it was really great to sort of to see it in writing. So the first one, as Melanie said, was around precariousness. It's like we live year to year. I've often said I never wanted to be an ED of a nonprofit. It's like you wake up every January 1st and all of a sudden you have to do it all again, cha-cha-cha. You have to, get all those grants again, et cetera, et cetera. That is the world that we're used to. So we hear you completely, but by sort of sitting down and getting to know your exact circumstances, what other sources of revenue you might have, support that you have in the community, we try to put together for ourselves a sense of the risk mitigations that occur. Because on the one hand, you do say, gosh, every year this is only a 1-year grant. This is only a 2-year funding program. On the other hand, chances are you've already been around for 10 or 15 years. So somehow you got there. So that's what we want to tap into as the potential lender. The second set of questions really were about stakeholder relations, in the sense that if you were using debt, some of the grantors might not be keen about that. The public perception might not be all that good. And you know what? In a lot of circumstances, those are probably valid concerns, but there clearly are circumstances where debt makes a lot of sense. Let's say you've been renting somewhere, and we had a loan many, many years ago, and it was a shelter helping women. They fixed the place they were renting. They fixed the place up. And the landlord comes in and goes, gee, that's great. Thanks a lot. Out you go. So they realized this was not sustainable, and they figured we really do need to buy our own place. Well, there's an argument. The stakeholders were really keen about that. And in fact, once they got their mortgage, the stakeholders really went to bat, having fundraisers and whatever to start drawing that mortgage down. So if there's a compelling argument where debt makes sense to get you to where you're going, I think you do have to make that argument to your stakeholders. But I think if you can, then that's kind of a win-win for everyone. There was another question about sort of risk and liability as it came to boards of directors, et cetera, and those are all excellent questions as well. And I'm not a lawyer at all, but I can tell you this, that it is the organization that is doing the borrowing. Yes, there are lots of demands on directors. They're expected to, do all of their due diligence. They're expected to know their bylaws, et cetera, et cetera. So I would say if you have legal counsel, then discuss them. And if they feel that the board of directors is within its powers and appropriately doing this, then it makes sense. But I also want to bring up in the thought I had when I was reading that question. Unfortunately, in many cases, board members themselves, in addition to the organization borrowing money, the board members are asked to personally sign as sort of guarantors for their debt. CAIF and CAIC don't do that. We either feel the organization and this loan can stand on its own merit. We would never look for personal guarantees, but to the questions that came in, that's a fair thing. Often when you go to the bank, they'll say, well, that's fine. We'll make the lend as long as the directors themselves guarantee the loan. And there was one other question about financial literacy, and we were really glad to see that. And that was kind of like, we don't do this because it's not where we are comfortable. And that's again where CAIF really hopes to help, to sort of up your financial literacy, to walk with you through this process. That's what we were set up to do. That's why we are a charity. That's what Revenue Canada saw as our charitable purpose.
Amazing. Thank you so much for the very insightful response. Now, we do have so many questions, so we're going to try to get to as many as possible, but if we don't get to your questions, don't worry, we are writing them down, and we'll make sure to send an email following up with the questions that weren't answered. So one of the questions we had was about how do you determine the amount of the line of credit for your organization? Do you base it on the percentage of your receivables, maybe your membership fees, or previous grants? They're just trying to understand how do they know what's the right amount for them.
I think how much we would approve could well be determined by some of those variables. But I think more importantly is what do you need? If you are looking at your cash flows, let's say over the last year, where were the gaps and how big was the gap? One metric that folks use is payroll. Like that's really all they need is to borrow maybe $30,000 because that's payroll. That's sort of the worst case scenario. I hope that answers their question. Yeah.
I think that does. Wonderful. And so we've had a few people asking about the line of credit, and is it solely for bridge financing or can it also be used for new projects? And if so, do you have any examples where it was used for a new campaign?
Bridge financing clearly is one of the needs of lines of credit. I think if it were a new campaign, chances are it would be more like a term loan, because really they probably would need the money, all of the money up front. And then as their operation gets going, hopefully their capacity goes up, their capacity to basically pay that loan down. So that's where really more of a term loan, if you're launching on something new, really a term loan makes more sense.
Okay.
I think speaking to that a bit, Beth, in terms of using a line of credit for a new campaign or project, it'd be quite expensive, and pulling all of that money and paying all of the interest on that versus having a term loan, which would be more accessible in that regard.
Mm-hmm.
Yeah.
Okay, great. And I guess just kind of building off this theme of line of credits, someone was wondering, are there limits that you would have? Like, is there a total amount that CAIF is willing to give to a charity, or is it very charity specific?
Yes, the maximum I think is on one of the slides. It's $50,000. However, you wouldn't be obliged to apply for the full 50, nor would we maybe give the whole 50 if a smaller amount made sense.
Okay. One of the questions we had was specifically about community bond transactions. And they were wondering if you're able to walk us through a time where you had to do a community bond transaction and kind of going over who does what and maybe an overview of what the first few years of a community bond would look like.
Okay, I'm going to be very brief on this because it's not something we do. I would really recommend that you get a hold of Tapestry because they have, and they're on our resource sheet. But I have been pretty involved with community bonds for a long time, and we actually have some community bonds in our portfolio. So basically, what has happened is basically the way a community bond usually happens is there is an interest by the charity or a nonprofit to purchase a property. They probably can get a first mortgage, that 60% that I was talking about in one of my slides. They may have 20% themselves. They've got a 20% gap. That's where the community bond goes in. And basically they raise the funds for the community bond. And once they've sort of got enough funds, then once they've got enough funds, then another mortgage goes on the property, usually a second mortgage, and there's something called a trustee who often holds the second mortgage. They are also responsible to all the bondholders. And so that's the basic setup. But as I say, I would really go to Tapestry. It's an interesting model, and as I say, they're set up exclusively to do that. But what the community bond does is really allows you to use another mortgage on your property and sell it widely within the community to your supporters. They earn some interest on the bond. You get probably a lower interest rate than you would if you had a conventional second mortgage. So it's kind of a win-win.
Great, thank you for answering that. Another question we have is, what is the difference between ROEBIA versus EBITDA?
They're virtually the same. They're virtually the same thing. Yeah. The point is, it's the cash that you have available to service your debt, and you take your earnings before amortization and interest, because actually interest is part of your debt service, and you don't put amortization in there as well, because I'm not saying it's not a real thing, but it's kind of a paper cost, if you will. You know, if you have a mortgage, and it's because you bought the building maybe 5 years ago, and it's amortized over the length of the building, well, that's kind of an accounting cost. It's not real cost. It's not real cash going out the door. The lender is very interested in real cash because it's real cash that's used to pay mortgages.
Great. And for those who maybe don't know what EBITDA is, do you mind explaining that?
Well, it's earnings before interest. Let's see, earnings before taxes, which is not relevant usually for many nonprofits. So it's earnings kind of before taxes, interest, and amortization. So as you can see, it's virtually the same thing as my definition there.
Okay, great. And if someone is having a mortgage, how much financial history do they normally need? For example, could a new nonprofit that's only 3 years old apply for a mortgage?
That's a great question, and it's kind of a tough question, because what's gone on in the 3 years is really kind of the answer. Isn't that's pretty wishy-washy. I guess what I would say is, as a lender, I'm looking for a balance between where you've been and where you're going. I work for a charity, a nonprofit that does social housing in the city. And their goal from the get-go was to buy a building and to do transitional housing and get folks off the street. Well, there was no history, but they were able to borrow money based on some other strengths going forward. And it was central to their mandate to be able to borrow money so that they could get this building and convert it into appropriate housing. So as I say, it kind of depends on what happened in your 3 years. And as a lender, you look at a blend between what has happened and what you hope will happen. Because I mean, the converse of it is that you could have had a terrific 10-year history, but looking forward, things don't look great. And so it's, as I say, it's a blend of the two.
Okay. And if you are applying for a mortgage or a loan or a line of credit, is there normally additional fees for setup and administration? And would this change based on the nonprofit?
Yeah. One of the other benefits that CAIF confers in doing our charitable work, basically, is that we have no fees. The organization borrowing from us has to pay legal fees, which is basically a third-party fee that we incur, so they pay that piece. But we ourselves do not take fees for the work that we do. That's sort of another sort of benefit that we confer in this space. It is not the case with conventional lenders, and organizations have to be very wary and understand upfront what all those fees are. And I will make the comment as well, a lot of organizations, I sort of talked about the situation where they have some money and they get a first mortgage and they maybe get a second mortgage, maybe from us, from somebody else. The more mortgages you have and the more players that you have, it can get really expensive really quickly. So, and we've seen this. I think everybody is interested in keeping the fees as low as possible. But the reality is, when the lawyers start talking, these are sort of legal transactions and business transactions, and they start talking to each other, and it's hard to turn. It's hard to sort of contain it.
Great. So we have a couple more questions and I see we're at 12:54. So we'll finish these questions, but if anyone does have more questions, please feel free to email us and we'll try to answer them. So the one question we have is very situation specific. So they write, our situation is likely unusual. They are a new not-for-profit and their charitable application is to be submitted very soon. When the transfer is complete, we're going to have considerable amount of assets, but we're going to have a big challenge to develop operating revenue. What financial tool would you advise to use? Based on what you said, it sounds like maybe a mortgage would be the best since we have a lot of assets.
That's right. If they're real estate assets, I would say yes. But you know, I'm glad this question came up because it's a good one, and it's why I did get into the business about debt coverage ratio, because it happens often that charities and nonprofits are kind of asset rich, but cash flow poor. So they have an asset, you get an appraiser in and it could be worth $2 or $3 million, especially a real estate asset. But if it's not generating a cash flow, it'd be like owning an apartment building with no people in it. Yes, it's worth, based on other apartment buildings in the neighborhood, it may be worth $4 or $5 million. But a lender's not going to lend on it because there's nobody in it to pay you rent so that you can pay your mortgage. So it is a real problem. And I have come across this over and over again. Sometimes groups will have a very valuable piece of land and they want to develop it for nonprofit or social housing. And so, yes, they have this asset, but they don't have any way to kind of convert it into housing, because it in itself, even though it's valuable when you sell it. That's the sad part. It's not valuable as an asset that generates cash flow.
Great.
I hope that answers the question.
No, that does answer
Yeah.
it. Another question we had was for ONN, and that is, will there be a webinar on social enterprise financing? So we are going to have a webinar on social enterprises in either September or October. So definitely look out for the emails and we'll make sure to send you guys a reminder when it does come out for anyone who is looking to do maybe a social enterprise model opposed to a traditional nonprofit model. And for our last question, we have, what does CAIF consider a small Canadian charity and how would they define small?
What?
Your budget, most, I think, is what we look at, and that's usually, correct me if I'm wrong, Beth, but 500,000 and lower, it tends to be on the small side of things. And that's where we're kind of tailoring our line of credit pilot program towards, is those small organizations, where the 25,000 or 50,000 is most useful in those situations.
Wonderful. Thank you so much for taking the time to answer so many questions. We're so happy to see such great engagement from everyone. And thank you for everyone who joined us on the webinar today. We hope today's webinar has given you some useful information on debt financing as a financing tool to support your organization's cash flow cycles. So we're going to be sending up a follow-up email shortly, which will have the recording and also a slide deck, which has some of the resources that we talked about today. We'd love to stay connected with each of you, whether it's connecting over social media, joining for future webinars or events, or becoming a member. Thank you so much, and please keep in touch.